Today I'll be teaching you everything you need to know to start investing. Whether you already have some experience or have no experience at all, this video is for you. I'll be teaching you how investing works, where to invest, what to buy, and so much more. I've split this video into multiple sections so you can easily find whatever you want to learn, and we'll start with an intro to investing. Investing is an easy way to passively multiply the money you already have. The most common type of investment is stocks. Stocks are offered by large public companies and allow people to own small parts of a company. You can purchase shares of a company's stock on the stock market. Then, if the company makes money and increases in value, your shares of the company will also increase in value. Another popular type of investment is exchange-traded funds. Instead of having to individually buy many different stocks to diversify your portfolio, you can buy a share of an ETF to have your money diversified automatically. Each ETF tracks a different exchange, which are tools used to measure how the market is doing. The most popular exchange is the S&P 500, which measures the average value of the 500 most popular stocks. So if you bought an ETF that tracks the S&P 500 exchange, your money would be diversified into those 500 stocks. If you consistently invest your money throughout the years, you can make immense wealth. But to make that kind of money, you need to learn how to properly set your goals. Ask yourself what you're trying to accomplish this year when it comes to investing. If you're just getting started, I'd recommend you aim for an easy, accomplishable goal, like 10% returns. But this can change based off how old you are and how much experience you have. If you're young, you can aim for higher annual profits. This is because if you do make a mistake, you still have plenty of time to make that money back. And the more experience you have, the easier it is to make winning trades. My general rule of thumb is to always aim to do slightly better than the year before. You don't have to become Warren Buffett overnight. You just have to make a consistent, long-term effort to keep improving. Another thing to consider is any expensive purchases you plan on making in the future. If you are going to buy a house in 2 years, you should shift your goals from growing wealth to preserving the money you're going to be spending. When you're deciding your goals, aim for the long term. Make every trade count and be patient with yourself. If you consistently set good investing goals, you will be way better off than if you didn't. But I'm not a financial advisor, so you should always come to your own conclusions. Now let's look at investing platforms. When you're deciding where to invest, there are tons of places to choose from. But there are 2 specific platforms that I recommend, depending on your experience level. If you're just getting started, I recommend investing on Robinhood. Robinhood is specifically designed for beginner investors, as it has an easy-to-use interface and offers beginner-level educational materials. Robinhood makes investing very simple with fast transfers and access to 24-hour markets. The downside to Robinhood is its ease of use can encourage impulsive trading among some beginner investors. It also lacks more advanced research tools and educational material. If you're looking for something more intermediate, I recommend Fidelity. Fidelity is more complex than Robinhood, which can make it harder to use for beginners. But its added complexity also comes with better educational and research tools. Also, the customer support for Fidelity is much better than Robinhood, making it a safer place to invest in the long term. So if you're just getting started, go with Robinhood. But if you want something more advanced, try Fidelity. Once you've picked a platform, it's time to choose what stocks to buy. When you're just getting started, it's best to stick with ETFs. This is because they take the least amount of skill to make money from. If you buy and hold an ETF, you can expect easy returns. In your first 6 months to a year of investing, I recommend sticking to ETFs. That way you can get a grasp on how the stock market works without having to learn the hard way. After a while of investing in ETFs, you can start looking at individual stocks to invest in. When picking stocks to buy, stick with companies that have been around for a long time. You can learn a lot about a stock's potential from their history. If a stock had a very volatile and inconsistent past, it will probably stay that way. But if you find a stock that has been steadily growing for over 20 years, it will probably stay that way. Some good examples are Google, Microsoft, or any other FAANG company. It's important that you only invest into companies that you believe will grow in the long term. Popular tech companies are the easiest to invest in because they are some of the most successful companies of all time, and odds are they're not going anywhere. But there are still many other stocks out there that could also be good picks. When you find a stock you like, only put a bit of money into it at first. For example, you could put 15% of your investment money into a stock and leave the rest in an ETF. Keep your annual goals in mind when you're deciding how much money to put into stocks. There's no need to be greedy off the jump and put tons of money into a stock if you don't need to. As time goes on and you gain more experience, you can gradually invest more of your money into stocks. After multiple years of successful investing in the stock market, you can consider buying more niche stocks. There are many stock advice platforms out there that you can use to research different stocks, or you can do your own research. Just remember not to rush anything. Keep your eyes on long-term growth, and you will gradually become a great investor. Now let's talk about investing for retirement. Investing for retirement is something that everyone should try to do as soon as possible. This is because retiring is expensive, and the earlier you invest, the better. $100 invested in a retirement account at 20 will end up being worth way more than $100 invested at 40. In general, you will need around 75% of your annual income each year while in retirement. It gets expensive quick, so start early. The two main types of retirement accounts are 401ks and Roth IRAs. 401ks are offered by your employer and usually offer a percentage match on how much money you put in. Roth IRAs are independent retirement accounts opened through a brokerage like Fidelity. The main difference is that deposits into a 401k aren't taxed, but withdrawals are. Deposits into a Roth IRA are taxed, but withdrawals are not. If you're young and in a lower tax bracket, it's best to put most retirement funds into a Roth IRA so you can pay the low tax rate now. If you're older, it's best to put more money into a 401k so you can get higher margins from your employer's match. Once you have money in a retirement account, I recommend you look into buying two different funds: target date retirement funds and mutual funds. Target date retirement funds adjust holdings over time to account for your age and risk tolerance and are a solid pick. Mutual funds are also very popular for their consistent returns. But this isn't financial advice.